A lot of people want to make money with a small portfolio, put a little bit of money down and make a lot of it back. While generally, I would say opportunities in life like this are just way too good to be true, but I do have an idea to share with you today. It's a strategy that can do exactly as I just explained. It's called a poor man's covered call. With covered calls, I see comments saying that you need a large portfolio or at least a medium portfolio of $10,000 or so. Look, I get it. I need to appeal to every option trader out there. So the solution to a covered call that requires 100 shares of a stock you don't mind owning and selling calls against is a poor man's covered call, and it requires way less money down and you can make way more returns. The difference between a poor man's covered call and a regular covered call is that instead of needing 100 shares of a stock, which is almost in all cases going to be several thousands of dollars, you can buy a deep in the money call option that has a far out expiration instead of 100 shares. The benefit is a deep in the money call option is going to have a high delta, and if you go out far enough, like 1 year, you'll make it a leap option, and that theta will be very, very low. So you'll be able to pretty much lease a call option for a very low price. I'll link below a video on LEAPS if you want to learn more about them. So basically, you have a cheaper way to run a covered call strategy, and a long call option allows you to sell short-term call options to collect premium. But it's not just that easy, and there are definitely better and worse ways of running this strategy we need to talk about. LEAPS give leverage which cuts both ways. If the stock stays the same or goes up, this leverage favors the poor man's covered call. In a falling market, this leverage works against you. Poor man's covered calls work great when you cannot afford 100 shares, for example, Google or Amazon. The anatomy of a poor man's covered call is usually buying a deep in the money option at a high delta, like 80 or greater. Many choose to sell weekly calls or even monthlies at a 30 delta. The reason you want to go for a deep in the money leap is because a deep in the money leap implied volatility is very reasonable and you'll pay minimal time premium. Sort of like leasing a car, except imagine leasing a very old car for a rock bottom price, but still getting all of the benefits. LEAPS have very little time decay or theta for many months, which means that the daily cost of ownership is extremely low for owning this position. On an expiration basis, the call leap has less catastrophic risk than share ownership if share prices drop. Below the strike price, the shareholder continues to lose, whereas the call owner loses nothing more. Prior to expiration, the leap has even less risk because as the stock drops, the delta of the call drops, and that means that the call leap will lose less than the stock for each dollar of the stock dropping. For example, if a stock drops $1, an 80 delta option will only drop 80 cents. But as the stock continues to fall, the delta will become lower and lower. So the further it drops, the less risk you have on the table, since delta can only go lower as things become equal. So the further it drops, the less risk you have on the table, since delta can only go lower, all things being equal. An advantage for the call leap is that if the underlying rises nicely, you can roll your call up. Pulling money off the table and lowering your risk level is something that you cannot do with a long stock. You'll give up some delta, but in return, you will repatriate some principal. The disadvantages of rolling up is taxation if it's a non-sheltered account. I do have a video on rolling that you can watch in the link below. I also do have a poor man's covered call open right now, and I want to show you guys, but before I go there, I want to discuss the disadvantages of a poor man's covered call first. Let's start with the disadvantages of a leap first. Leaps tend to have wide bid and ask spreads, so adjustments can be very costly. Try to buy back leaps at the midpoint or better. Theta or time decay starts to accelerate towards expiration. Initially, it's just pennies and will hardly impact your leap, but over months, it will start to increase. So I wouldn't necessarily call it a disadvantage as long as you know how to properly roll and close a poor man's covered call, which I will show you shortly in this video. Next, the share owner receives the dividend and the call owner does not. This isn't a big deal for me, but I want to throw it out there. I usually trade high growth stocks and I don't have any dividend payers currently besides maybe a couple stocks in my portfolio. I'm usually not trading for dividends at this point in growing my portfolio, but for someone who is closer to retirement, a dividend might make a very important difference in their income. Next, leaps can suffer from an inverse volatility effect. If the underlying has dropped a lot, implied volatility is likely to be higher, making them more expensive. Conversely, if the leap is cheap relative to other periods, the underlying stock could be closer to a bottom than a top. If you still like the upside potential of the stock, it's a good idea to roll your leaps out when they become traditional options, which is less than 6 to 9 months until expiration in my book. But if you want to be a stickler, I guess some people do have a cutoff at 12 months. You would cut off the leap at this point in order to avoid the accelerating time decay. Now that you understand the leap, the next part is the calls that you sell. If you follow all of this, the next leap for many, so to speak, no pun intended, is the income strategy called the poor man's covered call, where you use the leap as a surrogate for the stock and you write out of the money calls against it. Technically, this is a bull call spread, but it has different expiration dates. You might want to watch this video twice because it was even a little confusing to me when I first started experimenting with this strategy. Now for the short call, it works pretty similar to a covered call. In fact, let me just show you a poor man's covered call I have open right now on my computer. All right, guys, so I had a little bit of change of clothes here. I needed to wait a little bit for the market to open, but now that the market is open, it is 10:15 a.m. I'm gonna show you guys a poor man's covered call. Portfolio is doing really well today. This is just some of the results that I'm getting from option trading, so you should really join the Discord group if you're interested in that. But now let's take a look at the different options that I have here. Basically, I'm just gonna scroll down to Starbucks because Starbucks is what I wanna show you guys. For Starbucks, I'm running the poor man's covered call. Right here, as you guys can see, I am selling short-term calls. So this call is expiring on 10/22. On October 22nd, this option will be expiring. Basically, what I'm doing is I'm selling call after call every single week or 2 weeks for this option right here, poor man's covered call. This is something that I want to do a little bit less work on, so I'm not doing weekly covered calls, I'm actually doing monthlies, and that is the reason why this is expiring on October 22nd. And once this expires, I'm actually going to go out to the third Friday of November, which is going to be November 19th. So I'm going to be selling a call option for November 19th. But as you guys can see, the 10/22 call option right here is at a plus $34 gain. And if I do scroll down, you will notice that I'm down $488 on the $125 call option. And basically what's going on here, guys, is that I was running a poor man's covered call on Starbucks for quite some time now. In fact, I do want to go into my history and I want to show you guys exactly what happened. But before I do that, I do want to say that the poor man's covered call can basically go wrong if the stock goes backwards. If the stock starts pulling back and it goes down, you will lose a lot more money on the leap than the money that you can collect on selling covered calls. So for me, this position did not go well. I am usually a very successful trader. I've had a lot of success selling options, but with the poor man's covered call, this is one of the first positions that I opened up for the private group. I was very interested in doing this for educational purposes to teach my members how it's done, and it did not go well. And this doesn't mean that poor man's covered calls are not going to go well for you. This doesn't mean that poor man's covered calls are not a good strategy, but for one of the first poor man's covered calls I ever opened in my entire life, I'm just going to be honest with you guys, this is the only poor man's covered call I opened and I'm down 83% on the leap call option itself. It has completely pretty much decayed. It only has $96 worth of premium left. And I probably should have closed this position a little bit sooner, but honestly, there isn't much you can do if the stock continues to go downward. And for Starbucks has been not performing super well. So if we take a look at this call option, you can see that over the past month, because options just decay over time, because theta starts biting into the option as the option approaches expiration. Even though this option is expiring in January, it has had 74.74% of its value that has eroded in just the past month. And obviously the premium that I have been collecting has not been able to keep up with this leap option. So I have lost more than I have been able to collect. I do want to show you guys the history of how the anatomy of selling poor man's covered calls work. And by the way, I am not the biggest bull on this strategy in general. I just think it's a pretty neutral strategy. I think it's very good for people that have smaller portfolios and for people that want to try to make some money off of a stock not moving too much. For example, this did not happen with Starbucks, but if a stock were to stay pretty stable, you can continuously sell covered calls and just keep collecting the premium coming in week after week or every 2 weeks or every month. The strike price and the expiration date doesn't really matter as long as you're choosing a strike price that is farther out of the money than the leap option that you have. That way, even if the stock does end up appreciating, that wouldn't really hurt you that much because the leap will appreciate and you may have a short-term loss on the call option. However, more often than not, you're just going to be collecting that premium from that short call option that you have sold, and usually you should not be in that situation. However, you can be in that situation, and that's one of the drawbacks of running a poor man's covered call, which is a little bit riskier for me. It's a little bit more work. That's why I don't have a lot of these positions in my portfolio, because when you're dealing with a larger portfolio, running poor man's covered calls are going to be a little bit more risky. They're going to take up more of your time, and they're just less efficient to run overall if you're trying to scale a larger portfolio. With that being said, I do a lot of spreads, and those spreads are very profitable. I do run them on my Scaling with Spreads challenge, but honestly, with the poor man's covered call, let me just show you the results that I've had. Let me walk through my history right now. So if I go into my Starbucks history overall, I want to show you guys exactly when I bought that leap option, what I tried to do, and basically how it worked out for me. Again, this might not happen on all stocks, but for Starbucks, the stock is just down 6.73%. And actually, this didn't really end up being too bad for me because I was actually bullish on Starbucks at $120 per share. This is one of the few stocks that I was just plain wrong on. I just thought that it was going to run up. It didn't run up. It had a big pullback, but actually I didn't lose as much money if I would have had just bought 100 shares of stock. Instead, the poor man's covered call actually did end up saving me some money, because since I'm theoretically long 100 shares through the call option or through the LEAP option that I bought, it's not 100 delta, but it's a very high delta. So in my mind, I'm up 100 shares on Starbucks. So I didn't end up actually buying Starbucks stock. I only bought the LEAP option. And this is one of the benefits of buying call options in general. You can only lose the premium that you paid. So Starbucks had a really big pullback, but I'm not completely down as much as a stockholder would have been down. So I'm actually not that upset. And I just realized that at the moment of making this video. Now let's go down to my current positions. So I did recently sell a put option on Starbucks. This was something that I did for my personal portfolio. So I'm not going to go over that. I'm just going to leave that where it is. But now if we do take a look at the 125 call option, basically this is going out to January 21st, 2022. And honestly, in this video, I'm probably going to be closing this option and taking the L. But before I do that, I do want to go into the history and let's see how much I lost in total, why that happened, if I could have changed anything, because I don't think I could have really changed anything. Starbucks stock just went down. There's not much I could have done. There's not much anyone could have done, but luckily I'm pretty good with risk management. I didn't put too much money into this, so I had a bit of a loss, but that loss isn't really the end of the world because of risk management practices. So let's go down to exactly when I ended up buying the call option. Let's go over some of the returns that I've had. In terms of buying that call option, I know it's pretty expensive. Yep, there we go. So on July 30th, I ended up buying this option, which is pretty much August 1st. So August, September, and then we're not really even into October. So yeah, about 3 months right there in terms of, or actually 2.5 months, I apologize, in terms of the time that I've had this option open. So the 125 call right here, I bought for $585 on July 30th. And just out of interest, I do want to open up Yahoo Finance because I want to take a look at the technical chart for Starbucks and kind of see how it was behaving, if I could have changed anything. Again, I did want to close this position many times, but because it's such a small position and because I'm not really running this position in my private Discord, I haven't really paid as much attention to it. And this is a good opportunity for you guys not to only learn about poor man's covered calls, but for me to actually do a deeper dive analysis into the charting and the technical analysis of Starbucks, and if I could have actually made a difference. Could I have closed this position? Could I have made some type of decision that would have saved me some money? And the answer is probably yes, because paying attention to Starbucks would have been important for this specific position. So let's take a look at the chart. We have it open right in front of us. And July 30th would have been right around here. The stock actually ended up pulling back significantly. That's actually what got me really interested in the stock. It was over $126, it looks like, for multiple days. It had a double peak. I should have actually paid attention to that. Now that I look back at the chart, this little double peak right here was actually not good because it could not go any higher. The momentum completely shifted. Once I saw the momentum shift that much, I actually should have taken action, probably closed the position right around here. I mean, I didn't know this exactly. I thought maybe it would be cheap at 118, but once the stock really broke down to this point and we see that huge momentum shift, it would have not been a bad idea to just kind of cut the losses at that point. But again, I wasn't paying a lot of attention to it because this is not part of my main portfolio or my private Discord portfolio. So for me, it was basically just like an experiment that I was doing. It was not something that I was monitoring as closely. So looking back, I would have probably closed at $118.25 somewhere in August. Basically a few days later, this position didn't go well. I'm going to be honest with you guys, probably my ego is a little bit high and I was like, hey, let me just wait and see what happens. Now that I look at it, it was a close, but let's just see what happened anyways. I also did tell myself I do want to see this strategy up until January because this is the first time I'm running a poor man's covered call. This is not something that I did at Goldman Sachs. It's not something that I did at the hedge fund that I was working at. This is not something that I have really ran before. This is not something that I've researched. So for me, it was really interesting to see, can it actually bounce back? And Starbucks did not end up bouncing back. This is not really a loss. This is just a really good learning lesson for me and a really good learning lesson for you guys with basically my own capital. The stock was going down, and let's go into my history. Basically, I started off with the $585 investment, and then I started selling covered calls. So I sold this covered call for a week. As you guys can see, it was expiring on August 6th. So I collected $12. I bought it back, which is a roll. On August 4th, I ended up buying it back for $3. And I basically sold another call option for August 20th, and that was $14. And again, because Starbucks is going down, I'm going to continuously be able to roll these options, continue to collect the premium, but unfortunately the LEAP option itself is completely dying and bleeding. Now, if I take a look at August 18th, a couple days before expiration, this was probably on a Wednesday because options expire on a Friday, I closed this position for $1, and then I ended up selling a 125 call. So what happened at this point was I sort of realized that I'm down in this position. The only thing I can really do is manage the losses losses of the position. I'm not going to come out a winner on this specific trade or this specific poor man's covered call. So what ended up happening was I started to reduce my strike price. So as you guys can see, I basically was selling 126 calls. I was being pretty aggressive. I was selling 126, and the leap option, if you guys remember, is a 125. But then I kind of figured, hey, I'm totally fine just kind of trying to break even or losing as less as possible on this position. So I ended up starting to sell 125 calls. I got canceled on that position. It didn't fill. So I just sold the 125 call. I think I was probably going for like 16 or 17 or $18. I'm not sure at this time, but I ended up getting $15 for this call option. And then I actually ended up selling another call option, but this is on my current position. And then this option ended up expiring. So the $15 expired. And then on September 8th, I ended up opening another call option, but I again went lower for 122. So now that I realized this option expired on 9/3, which means about 9/6, I was able to sell a covered call again, but I didn't end up doing that because I was so busy trading spreads and I started the scaling a spread challenge. So I ended up missing a couple days, but I opened up the 122 call option right here for $18. So as you guys can see, I'm collecting like 15 bucks, 18 bucks, 14 bucks. I'm closing it for like $1, $2, or $3, right? I am making decent income, but again, the leap option is approaching expiration and it has a lot of delta. And that delta is overpowering any of the delta that I'm selling call options on, because the options that I'm selling out of the money have a lower delta. And in fact, they have a lower theta. The theta is higher for the leap option because it has a higher value. So the theta is just overpowering, and I'm continuing to lose on the leap option itself much more than I can collect. And then as you guys can see, on September 17th, I bought back the option again for $1. I'm continuously rolling these options because it doesn't make sense for me to really hold them into expiration and then trade on Monday. I'd rather just close it for $1 and then open up another position. And then I was getting a little bit frustrated here. I didn't really know what to do. I could have just cut all my losses at this point, but I didn't end up doing that. And the reason why I didn't was because the leap option itself was becoming very cheap. I don't remember what it was at September 17th, but say that it was at $100. So when I would look at the leap option at $100 and I see I can sell the call option for October 22nd for $42. If you actually think about it, if you do the math right there, basically $42 as a income source from the covered call, as opposed to the leap option that I'm holding for $100, is actually going to be a 42% return, because 42 divided by 100 is 42%. So for me at that point, I could have closed the option, but honestly, I was just having a little bit too much fun at this point because I already had made the loss. I already had accepted that I had made a loss on Starbucks. And at this point, I just want to recover again, pretty much the same mentality I had before, recover or recoup as much money as possible from the poor man's covered call. So I ended up selling the 122 call expiring on October 22nd, which is just 10 days away from making this video. And I collected $42 from it. And as you guys saw earlier in this video, that option had pretty much decayed. So what's going to happen is most likely I'm again going to buy back that option for $1 or $2. And again, I'm going to try to collect maybe 42 or maybe even hopefully a little bit more money, and just basically aim for making about $100 to $150 more dollars. However, the leap option is worth $96. So I'm going to be losing $96, but hopefully I'm going to be making about $150. If implied volatility is decent on Starbucks, because it is down, implied volatility might be up just a little bit. So I might be looking to sell 120 calls, maybe 121 calls. I'm not exactly sure what I'm going to do on October 22nd, but basically I have two different choices. I can just cut my losses and just close out the leap option, sell it for what it's worth, which is $96, or try to sell enough covered calls to make up for that $96. Not exactly sure what I'm going to do yet. I'm going to be assessing that as the option gets closer to its expiration. And then the really cool thing with the poor man's covered call, or I guess the cool thing that happened to me, is because the stock is down, I am down on the poor man's covered call. I accept that. However, now because the stock is down so much, it actually presents a very good opportunity to sell puts on. So I have ended up selling two different puts on Starbucks stock, and I collected $74 both times, it looks like. One time on October 5th, I ended up selling a put. It went successfully. And then as you guys can see, just 20 hours ago making this video, I have sold another put at again 109 strike. And again, I have collected $74 2 weeks in a row. And I pretty much just plan to continue to sell put options on Starbucks as long as it stays near these levels. If it does end up staying at these levels, I'll just make some more money selling puts. And if it does end up going up, then my leap option will be a bit more expensive and I'll be able to sell it for a higher amount. So either way, I'm pretty happy with Starbucks, whatever it does. But that is a learning lesson for me about the poor man's covered call, is that when a stock does pull back, you may not recover all of the money that you have lost from the decay of the leap option itself. And that's totally okay. That is a risk in trading. Every option strategy does have a downside pretty much, but selling puts and running the wheel strategy are the two best strategies that I have, as well as covered calls. I will have all three of those videos linked for you guys in the description below. If you want to see my live trades, my option signals, have access to me, two different coaches, a licensed CPA, you can book a free call by submitting an application in the first link below for my private option Discord. Thank you so much for watching. Invest safely, and I love you guys.